With rates trending lower in Canada and the United States, some interest-sensitive sectors like REITs and utilities have begun to move higher. We haven't seen the same move in telecoms. Joining us now to discuss whether that's set to change, Vince Valentini, Managing Director for Equity Research at TD Cowen. And for full disclosure on the companies covered by TD Cowen, please see the link to the website at the end of this program. Vince, great to have you back on the show.
Thanks, Greg. Great to be here again.
So this is something that a lot of investors have been waiting for, obviously a rate cutting cycle. We began before the Americans. The Americans jumped in with a half basis point. So it is underway. We have seen, as we said in the intro, some other sectors behave the way we thought they would because they're rate sensitive. What's going on with the telecoms?
Yeah, well, one more to your list is if you look at the telcos south of the border, AT&T, Verizon, and T-Mobile all up between 20 and 30% this year. So you definitely are seeing rates help a lot of sectors. The Canadian telcos just can't seem to get out of their own way in terms of bad news. The big picture bad news, which I think I've talked about on this show a couple of times before, is just a price war. We are seeing the worst pricing environment in the wireless industry that pretty much everybody I talk to in the industry has seen it in their careers, and certainly in my career as an analyst. Seems that I know you're going to ask, are things going to get better? Things seem like there's some green shoots that price war is ending, but the results we've seen in the past 4 quarters and what we will likely continue to see in the upcoming third quarter results are going to show the nasty edge of pricing being quite weak. So volume of subscribers is good. There's good growth on that front, but the pricing is offsetting all of the volume growth. So we're now down to virtually zero service revenue growth for all of the 3 big wireless carriers. So that's the biggest sort of overhang. Each company has their own company-specific sort of problems, whether it's the MLSE deal at Rogers that people don't understand, it's the dividend quality or payout ratio at BCE that people are concerned about. TELUS has their non-telecom businesses that are concerning people, and TELUS International has been the prime sort of target on that front. And all of that culminates with, debt leverage is pretty high. So there's not much margin for error as far as investors are concerned when they look at, again, go back to those US telcos that have done much better. On average, they have about 2.5 times debt to EBITDA ratios. The Canadian guys, BC and TELUS are more like 3.5 times. Rogers is up at 4.7 times. So people are saying combination of uncertain pricing environment with higher than sort of normal debt leverage probably leads to us saying, you know what? Even if rates are coming down, there may be safer places to put our money. That's the sort of backwards-looking view, Greg, as to why the stocks haven't done as well as some other rate-sensitive sectors so far.
When it comes to that pricing war, is it a little surprising that someone hasn't backed down at this point? I mean, that's the whole thing, right? Because it's been going on for a while, and I think a lot of people were thinking it was like, there'll be a certain point where one of these companies just says, listen, we need to back away from this. No one seems to be backing away.
Well, no, we have seen people back away a little bit. So when I mentioned earlier, there's some green shoots. So I am still very bullish that this sector will do much better over the next 12 months than what we've seen over the past 12 months, especially, as you're going to talk about later in the show, as the Bank of Canada likely continues to cut interest rates. The yields and returns of free cash flow yields on these names just start to look too attractive to ignore. But we do need to see some of that sort of somebody backing down and some stabilization. We saw that starting in late July. So as we've talked about before, this all started with Rogers buying Shaw, being forced to sell their wireless business to Quebecor, and that made Quebecor a much stronger near national player. So we effectively have a disruptive 4th carrier in the wireless industry, which for years we didn't have. It was more of a cozy oligopoly with everybody keeping prices reasonably high and disciplined. That upset the apple cart. Quebecor spent about a year trying to find their footing. They had to figure out how to market that Freedom business properly. They had to get their retail distribution better. They had to figure out how to do internet in bundles with wireless, a whole bunch of sort of blocking and tackling that they had to do. In the interim, they said, we still want a lot of customers and we have a low cost structure, so we'll just use price. We will just lower price even more than where Rogers, Bell, and TELUS are, and that'll get us our customers. And they certainly did that. They've started to pivot in late July and say, okay, we've got those other pieces of the puzzle in place. If we can win customers on a bit more of a blend of quality and price, it's better for their long-term business model. And that we're starting to see that. And they've held the line. The prices increases they announced in late July have held right through till today, all the way through what's usually a noisy back-to-school period. So that's one dynamic of seeing some stabilization. If Quebecor is less aggressive, the 3 incumbents are probably going to be less aggressive because they have such a big installed base of customers. They don't want the price war to continue. It could be very painful for them. The other thing I would just point out is everybody sort of has talked about how great the volume growth has been in the Canadian market. Last year was basically record levels of subscriber growth, driven obviously in part by high levels of immigration in Canada. There's a double-edged sword to that. When the pool of new customers is so big, these carriers look at this and say, wow, we haven't seen this type of volume growth for a decade. We want to lean into that. We want to get our piece of that pie while it's there, because a year from now or 2 years from now, who knows, that the pie might not be growing that big, and most people think the Canadian government will, put the brakes even further on immigration, so there won't be as much subscriber growth. So I think everybody attacking that pool created a bit of undiscipline, and now that people are saying, okay, the volume growth is leveling off, hopefully there'll be a bit more of a balancing act. So on the one front, Quebecor is getting more disciplined. On the other front, the volume growth will hopefully get people to play nicer on price, and we have seen a bit of better pricing action in the last 2 months, which to me, again, is why I think looking forward things could get better.
Interesting developments. You mentioned discipline and you mentioned debt earlier. When it comes to debt leverage and investors waiting for some discipline there, are you seeing any moves?
Absolutely. So I would say, I've covered this sector for 30 years. It's not always the most disciplined sector when it comes to capital allocation. Some of these companies make acquisitions sometimes that they spend too much on, or some investors don't understand the logic of it, or they sometimes spend too much on CapEx, too long-term focused without paying attention to the short-term cash flow or the short-term balance sheet issues. When this industry, though, gets backed into a corner and feels pressured, they have lots of ways to lower debt leverage. And we're finally seeing some recognition from the companies. BC's had their debt downgraded by S&P and by Moody's in the last couple of months. Everybody's critical of where Rogers' debt leverage is. TELUS, has issues as well. I think out of that sort of pain comes a bit more, attention to detail. And the biggest thing these companies are now doing is looking at selling non-core assets. There's also going to be reductions in CapEx going forward by all the players, so there'll be more free cash flow to pay down debt. But on the non-core assets, BCE's deal was a clear sign of that. I would say capitulating somewhat on an asset that they've always said they wanted to keep ownership of.
The sports, right?
But yes, agreeing to sell MLSE for $4.7 billion is showing that they're very serious about reducing their debt leverage. TELUS is talking about multi-billions of dollars of proceeds from selling real estate and selling copper now that they have an all-fiber network. Rogers is articulating at least $1 billion in asset sales over the next year. So I think the good news is the management teams now realize how serious the problem is, and they're paying more serious attention to it. And that means we should see better traction over the next year, because they're all asset rich. They all have assets they can sell if they want to. They can all spend less on CapEx if they need to. So I think the first point is they have to recognize there was a problem. And for a long time they weren't, and they were quite happy to keep debt leverage high. The good news, Greg, is I think they're all now quite motivated to do what shareholders want and get that debt down over the next year.